Inflation is back in the headlines. The latest U.S. Consumer Price Index just came in hotter than expected, and Wall Street is reacting fast. So, what does this actually mean for you and your money? Does this signal that the Federal Reserve might have to delay those long-awaited rate cuts? Or is this just another temporary bump in the road to a full economic recovery? We're going to break it all down for you. Welcome to Level Up Finance, your simple guide to money, business, and success. Let's dive right into the numbers. In August 2025, the U.S. Consumer Price Index, or CPI, rose by 0.4% from the previous month. On a year-over-year basis, that's a 2.9% increase. Both of these figures are slightly higher than what we saw in July. Now, you'll often hear economists talk about core inflation. This is a crucial metric because it strips out the volatile categories of food and energy to give us a clearer picture of underlying price trends. Core inflation rose by 0.3% for the month and is now sitting at 3.1% year over year. So, what's driving this? Well, energy prices ticked up by 0.7%, and anyone who has been to the grocery store lately won't be surprised to hear that food prices jumped by 0.5%. These two categories contributed heavily to the overall increase. What these numbers really tell us is that while inflation has definitely cooled down from the crazy peaks we saw a while back, it's proving to be quite stubborn, or sticky, as economists like to say. This stickiness is especially noticeable in essential categories that hit our wallets the hardest, like housing and groceries. The battle against rising prices isn't quite over yet. So, why is a seemingly small uptick in inflation causing such a stir on Wall Street? It all comes down to a few key factors. First, and most importantly, is rate cut uncertainty. The Federal Reserve has been signaling for a while that it plans to lower interest rates soon. Lower rates make borrowing cheaper, which stimulates the economy and is generally great for the stock market. However, these new, higher-than-expected inflation figures could force the Fed to hit the pause button on that decision. They need to be absolutely sure inflation is under control before they start cutting rates, and this report might make them more cautious. Second, let's talk about market expectations. For months, many traders and investors have been operating under the assumption that rate cuts were just around the corner. In fact, they priced this expectation into the market. When this inflation data came out and challenged that assumption, it created a ripple effect of uncertainty. That uncertainty often leads to short-term volatility, especially in the stock market, as traders quickly readjust their positions. And third, we see a shift in investor behavior. Historically, when inflation rises unexpectedly, investors tend to get a bit nervous. They often move their money out of riskier assets, like high-growth tech stocks, and into what they perceive as safer havens. This can include government bonds, which become more attractive as yields rise, or even commodities like gold, which is often seen as a hedge against inflation. This shift can cause a pullback in the broader stock market. But there's a bigger, more complex picture developing beyond just these headline numbers. We need to talk about a few red flags that are making analysts and investors even more nervous. Recently, it's come to light that the Bureau of Labor Statistics, the agency responsible for compiling the CPI report, has been facing significant data collection issues. These problems are reportedly due to staffing shortages, which could potentially affect the accuracy of the inflation reports we're all relying on. This creates a serious problem when the reliability of the data itself is in question. It makes the Federal Reserve's job incredibly difficult. How can they make multi-billion-dollar policy decisions if they can't fully trust the numbers they receive? This also means that some government data releases might face delays in the coming months, making it even harder for the Fed and financial analysts to get a clear and timely reading on the true state of inflation. This kind of uncertainty is something the market absolutely hates. Volatility tends to spike whenever the data looks unreliable because it's like trying to navigate a ship in a thick fog. No one is quite sure which way to turn. So, as an investor, how should you navigate this tricky environment? Here are a few key things to watch. First, don't just assume that rate cuts are a sure thing. The Federal Reserve might decide to wait much longer than the market currently expects. Be prepared for a higher for longer interest rate scenario. Second, it's crucial to look beyond the headline inflation number and keep a close eye on core inflation. Core inflation gives a better sense of the underlying price pressures in the economy and is what the Fed watches most closely. Third, consider focusing on defensive sectors in your portfolio. These are industries that tend to perform relatively well regardless of the economic cycle, like consumer staples, utilities, and healthcare. People still need to buy groceries, pay their electricity bills, and see a doctor, even when the economy is shaky. Finally, what about those high-flying tech and AI stocks? They'll likely remain volatile in the short term. However, for long-term investors, any significant pullbacks or dips caused by this market uncertainty could present attractive buying opportunities. To sum it all up, the good news is that inflation is cooling from its peak. The bad news is that it's not cooling down fast enough for the Federal Reserve to declare victory and relax just yet. How this dynamic plays out over the next few months will be the deciding factor for when we see rate cuts, which direction stock market trends will take, and ultimately, how your portfolio performs. This is Level Up Finance, where we explain money, business, and success in a way that's easy to understand. If you found this breakdown helpful, don't forget to like this video, subscribe to our channel, and hit that notification bell so you never miss our next financial update. Thanks for watching.